I think that the market's going to end the year higher than where they are today. And people are mostly focused on all these negatives. And what they're ignoring is there's a lot of other positives out there. You know, last week, for instance, where the markets moved down, one of the things that's worth looking at is there was no contagion into credit markets, right? BAA spreads actually tightened. There was very little treasury market volatility. And the message to me is that this is really an equity-oriented problem, right? And credit markets are generally better at sniffing out these fundamental problems or fundamental turns in the economy. So to me, it says it's equity investors that are overly focused on, you know, these risks or problems that are going to be coming in 2019. And what they're ignoring is, you know, third quarter earnings up being 27% year over year. When we started the third quarter earnings cycle, consensus was like for 19% earnings growth, and we're at 27%. And if you look at corporate profitability, companies are paying the lowest taxes that they've paid in basically 25 years. And that's not something that just eclipses at the end of this year. I think that continues into 2019. So I look at the environment out there, and I think, you know, the markets are going to head higher for the rest of the year.
When you mentioned the bond market sniff things out, does oil, Sarat, ever sniff things out? And if so, what is it sniffing out with this bear market?
I mean, our view is you're getting a head fake from the oil markets because of all this geopolitical
supply and
supply issue. We had the same thing 2016 when oil goes down. People look at it and say, well, that's a demand issue. But what we've seen, companies are not talking about that.
You'd stick that into some type of model to try and figure out equity prices. Wouldn't you? You'd figure out oil's behavior, but maybe
yeah, I mean, you try to see what it correlates.
Maybe it's a one-off.
The problem is that if it's all it's telling you is that there was a decision by OPEC to pump more. It doesn't give you any.
At 85 to below 60.
What's interesting
is a little above 60.
When oil goes back to 85, 90, the markets get really scared, right? Because input prices are going up, transport prices are going up. But even in light of all this, all your cyclical stocks are down. Right? I mean, the airlines are up, yes, but your other transports are all down.
It's such a small sweet spot for oil prices. Was it $70 and everybody relaxes?
70 when everybody's happy.
By the way, the global price isn't down as much with the dollar where it is.
So I think if you look at that, but to your point, you know, we agree that cyclical stocks are priced as if we're going to a recession. So what do? Go to secular growth? Those stocks are getting killed as well now too. So if you're hiding out, but when you look at everything out there in terms of all the inputs, it's not like we're walking into a recession and we're being priced as if we're in a recession. So I think next year is going to be an interesting, if you are a long equity holder and you think there's some growth like we do, there's a lot more opportunity than kind of staying on the sideline.
I have a question for you guys, whether it's a signal of something, which is today you saw, we're going to have them on the air at 8 o'clock, SAP by Qualtrics. Yeah. This is just another example of a unicorn that was about to go public that basically decided, no, I don't want to do that right now. I'd prefer to get bought. And then we've had now probably half a dozen of these situations, literally in the past 12 months. What does that say about the confidence you think CEOs have in this market right now? Or do you think it's something else?
Well, I think top-line growth is very important. IBM did an acquisition as well, and all these other companies.
Oh, no, I'm not talking about the buyer. I'm talking about the seller.
Yeah.
Well, I think absolutely. In a seller's market today, these valuations, like I said,
do you think it's just strictly evaluate? Well, this is a all-cash deal, by the way.
All cash deal. A lot of these are all-cash deals.
So is IBM.
And to us, that means if you're a seller with these really high valuations, it's probably a good time to get out.
But what does that mean if you're a buyer, that you're a sucker?
No, I think buyers are looking, these are the companies that are now looking for growth. Right?
So it's a strategic buy, and if so, that makes sense to some of these companies?
Exactly. They're looking to say, how do I grow my top line? And at this point, some of these large tech companies have become so large that you can get something like this that could be accretive. The market would then.
So let's say you're a computer program, you're artificial intelligence, and you see oil prices down 20%, you see cyclical stocks really weak, and you see the Fed raising interest rates, and you see, you know, well, you put in some Kramer input about the pockets of weakness in the economy, you put in Trump saying you're going way too quick with the Fed. Why not think that the Fed is overshooting too much and that a recession is more near term than people, because people say no, wait, 2019. They say 2020, 2021. How do we know? How do we know we're not getting signals right now?
If you look at the consensus estimates, you know, they are pricing in the yield curve inverting in the middle part of 2019. They're pricing in the 10-year Treasury yield topping out around 3.4% by the end of 2019, 2020, and then a recession. I think what everybody is missing is that the seeds of a recession are generally going to be like in excess capacity or like an economy overheating. There's just no evidence of that whatsoever. So I think we end up going a lot longer than people expect in this cycle, which means we might get a cyclical dip, right, as 2019 has to digest really fast or really strong earnings gains from this year. But it argues that we do have a lot of years left. It's interesting. If you look at the economy, for basically 50 years, the U.S. economy grew at about 3.1% up until about 2008, when growth legged down to about 2%. And it's not as if the economy has to magically close this gap, but basically our companies have been geared toward about 3% GDP growth for so long that when you take a decade of 2% growth, it means you just don't have excess capacity. There's no evidence that we have an economy that's about to overheat and thus roll over. I think the cycle goes on for years longer than people think.